Well, Anthony Chan joins us to provide some insights into what the rate cut means for the U.S. economy. He's the former chief economist at JP Chase. Hi there.
Good to be here with you, Gerald.
Always good to see you, Anthony. So after 4 years, a half-point cut, do you think this was too aggressive for what the economy needs right now?
I don't think it's too aggressive. I think it was a little bit of a surprise to some people in the financial markets, but as the date was approaching, more and more people were thinking that it was going to be 50 basis points, as the Fed chair indicated very clearly that he feels it's a down payment. And the reason why it was a higher down payment is simply because we've seen inflation come down sharply, and now is not the time to keep monetary policy so restrictive. Keep in mind that monetary policy is still restrictive because when you look at the Fed funds rate and you look at the underlying inflation, there's still a wide gap between the two. Inflation has come down, but the Fed funds rate has not. So the Federal Reserve felt it was time to start normalizing those rates. And they made a slightly larger down payment than the market was expecting, but it's not out of the ordinary.
So the markets seem happy, Anthony, but crucially, for the average American, how are they going to feel this in their day-to-day spending?
I think that on the day-to-day spending, you will see some easing of rates, credit cards, maybe some loans. But with respect to the mortgage rate has already come down pretty sharply. If you look at the peak in the mortgage rate, it was above 7%. It's come down closer and closer to 6%. So we've already seen the financial markets sort of taking into account potential Federal Reserve moves. So again, you will continue to see further declines, but you've already seen quite a bit with regard to the housing market.
And when will the economy feel the effects of this rate cut? Because some of it could be immediate, but a lot of it is also quite long-term, is it not, Anthony?
Yes, we've always been taught that monetary policy has these long and variable lags. If you look at the data, and I've looked at it very carefully, those lags have compressed to some extent as financial markets now move a lot quicker than they did a decade or 2 decades ago. But there's still some lags out there. But again, a lot of the easing has already taken place. When you look at the 10-year Treasury yield, that number has come down sharply from its peak and will continue to come down as the Federal Reserve lowers interest rates. But keep in mind, one of the things the Federal Reserve chairman said to make sure that no one felt this was a panic move, the Federal Reserve made it very clear the economy is on a solid path. It's growing quite rapidly. They just want to keep it that way. So again, they made it very clear that this was not a panic move. This was not a move to pull the economy out of recession. The economy is not in a recession today and not likely to go into one anytime soon. So it was not a panic move, and I think they tried to make that point as clear as possible.
So even though we're really talking a lot about this here in the US, it's also being watched around the world. What is the global impact of a rate cut in the US?
Well, certainly you're going to see that as interest rates come down, it sort of weakens the value of the dollar relative to other countries. But you also have to keep in mind that other countries around the world started lowering interest rates before the Federal Reserve did. The Federal Reserve waited. And maybe one of the reasons why they were so aggressive is because they were waiting for quite some time. The European Central Bank has already lowered interest rates. Other central banks, the Brazilian Central Bank, others have already lowered interest rates quite aggressively. So again, the Federal Reserve is following. It was lagging. And one of the reasons why you could argue they were catching up to the rest of the world.
Anthony Chan is the former chief economist at JP Chase. Thank you as always to help us make sense of these numbers.